Good morning, good afternoon, everyone. Thank you for joining us today in this festive December edition of ARIVE Partner Spotlight. ARIVE Partner Spotlight is a monthly webinar series that we host. For those who are joining new to this series, welcome. So in these webinars, we try to bring thought leaders and experts from mortgage lending communities so they can talk about topics that are relevant in today's market and that can help you grow and scale your business. My name is Harish Tejwani, along with my colleague, Amy Hulett. We will be moderating this webinar today. In this webinar, we are truly embracing the spirit of holidays by covering how you all can unlock more home buying opportunities for first-time home buyers by using state-bound down payment assistance programs. Joining us today is our awesome partner, our newest partner, Sierra Pacific Wholesale. They are truly one of the pioneers in bringing these programs, which are offered by state housing finance agencies, to mortgage brokers. We are very excited to have them, and they will unravel different programs available in different states. We'll start with California, then go to Texas, and then to Florida. If you have any questions at any time, feel free to use the Q&A tab below. So we will be taking these questions as they come. This webinar is being recorded, and it will be available on ARIVE's YouTube channel in a few days. And we are also streaming this live on ARIVE Mortgage Brokers Facebook group to share the joy and knowledge. With this, let's jingle into the session. But before I start, I'm going to do a quick audience poll, as we always do. So let me run a quick audience poll. So we have a quick poll for our users, mortgage brokers. Just take a second to answer these two questions. Have you worked with Sierra Pacific Mortgage before? And have you ever closed a loan using any of the state bond down payment assistance program? So we'll give a few seconds. So thank you so much for answering these. All right, I'm going to close the poll in 5, 4, 3, 2, 1. So almost everyone has answered. So I'm sharing the results. So with Sierra Pacific, it is 50-50. Almost 50% of the brokers who are on this webinar have not done business with Sierra Pacific. So we'll encourage you to get yourself approved. They're an amazing lender. We'll be sharing their contact information. And another interesting fact is 50% of our audience, more than 50%, has used a state bond DPA program before, which is interesting. But 47% of you guys have not used these programs. So hopefully all of you will learn something new. With that, I'm going to hand this over to my colleague, Amy Hulett, who's our Director of Sales. She was actually with Sierra Pacific for quite some time. So Amy, do you want to kick it off?
Absolutely. Thank you so much. I definitely have a special place in my heart always for Sierra Pacific and its team. The people there are what make Sierra so great. The tenure of all of the employees are what make it very special. And so when we were wanting to put this together, we really wanted to make it something that so many of our originators could really use and leverage right now. And as we go into 2024, so many LOs are licensed now in multiple states. And so this is allowing them to really utilize their licenses across multiple states and learn about different state bond products. So we think it's going to be really valuable to be able to learn about all of these products in all of these high volume states today. So again, thank you everyone, the panelists here, for joining. And I'd like to just hand it off to Rob. He's the Senior Vice President for TPO Sales West, and he's going to tell us a little bit more about Sierra, what they're all about, so we can get going.
Thank you, Harish and Amy. We appreciate, and you know how excited we are for this new partnership. I fought hard for the partnership because we wanted Sierra Pacific to get exposure with the ARIVE community. based on the poll, many of your ARIVE users have used Sierra Pacific in the past, and they were begging for us to join the platform. So we're here. For those of you who haven't used Sierra Pacific before, you'll want to consider it. We have been there for the broker community through thick and thin for over 30 years. It's pretty incredible. The truth is Sierra Pacific has something unique to offer, and more people need to know about it, not only because of our state bond down payment assistance programs, but our experienced underwriters and our hands-on customer service. We do all loan types well, and I like to call that a full service experience, and I'll explain what that is. I know it sounds like going to a gas station, but it's better. We also think your platform, ARIVE, has more value to offer brokers and loan officers, and we're all about that. So again, thank you for having us and doing this partner spotlight. Today, I have with me two expert account executives to cover multiple state down payment assistance programs. Sierra Pacific, hands down, is the most experienced state bond lender that I have ever worked for, that I can think of in the market. They have many years experience and have had tremendous success, specifically with the CalHFA program here in California. And because of that huge success, other states around the nation who prior only offered these programs to retail loan officers have reached out asking Sierra Pacific to be the first wholesale lender allowed to offer these state bond programs to the broker community, specifically Florida's Hometown Heroes and Home Sweet Texas. We're very proud of that. So before we hear from the experts on these programs, I wanted to quickly let you know more about Sierra Pacific and that full service experience I mentioned. Sierra Pacific has been serving the broker community for over 30 years, and we're licensed in all 50 states. Sierra has successfully navigated many markets, and we're currently thriving. The fact is, Sierra Pacific was built for this market, built to survive. And let's face it, everyone knows interest rates are high, and so are tensions. Today's transactions are tough. They require more than just automation. Mostly intricate purchase transactions that require hands-on service with lots of experience and a deep understanding of underwriting all income types. And that's exactly what our team at Sierra Pacific represents. We have some of the most experienced, hardworking account executives that I've had the pleasure of working with. Amy said it best, the tenure here is incredible. Okay, so what is a full service experience? At Sierra Pacific, that means you can speak directly to the underwriter who approved your loan. Our industry best underwriting staff will definitely grab your attention, and our full service experience helps more first-time homebuyers close on time. Super important. In fact, our underwriters email the loan officer directly when the loan is approved. Our ops staff provides clear communication and follow-up to make sure contingencies and closing dates are met. Direct access to all of the operations staff assigned to that loan. And we promise a smoother process. We're always working to improve. Our clients' experience matters, and that includes amazing tech. Through my career, I've worked on many platforms, and our proprietary technology, Express Loan, is simply the best. Modern look, fast, and it's super easy to use. Pair all of that with a competitive price, great people, and a full product suite, and a ton of full service resources we offer our partners, like a full formal TBD approval. Hands down, the best condo team in wholesale today. I can say that with a lot of confidence. Help with scenarios, help calculating income, to name a few. You need Sierra Pacific's offering in your tool belt. Okay, all right, so now to the good stuff. I'm joined by Brina Hertzler and Paula Corrigan. Brina is going to start off speaking about CalHFA. No one does CalHFA like Sierra Pacific Wholesale, and Brina is an expert. She's been with Sierra Pacific for 16 years, so she's also a Sierra expert. Brina, please tell us all your knowledge. Train us on this product.
Thank you so much, Rob. I am excited to be with you guys today, and I think we can all really agree that this has been a really long bear market, and it's important to kind of look ahead at what's coming down the pipeline in the next several years to a decade. And really what's coming is first-time home buyers. Millennials are aging into their home buying years, and they outpace the former largest population group, the baby boomers, by 3 times the amount of people. They also heavily believe in building wealth through home ownership, and they not only want to have a conversation about down payment assistance with you, they're going to expect that you have that as part of your conversation with them. That is why having CalHFA and other state bonds in your tool belt and knowing about them and having a lender that you can really trust with those is super, super important. So I'm excited to talk about CalHFA today. Before we get into CalHFA, I just really want to, for a moment, talk about Sierra Pacific. So I, as Rob said, have been an account executive with Sierra Pacific for the last 16 years. And the resurge really in popularity that Sierra has experienced in the last several years has been really due to the investments that we have made in modernizing our processes, our technology, and really pairing that with, like Rob said, a full service team that is working along. We become like really an extension. Our team becomes an extension of your team. And so being able to pair that with super experienced account executives, really career underwriters that you can speak to and work through your loan with makes such a huge difference, not only with CalHFA, but all of our loans. I mean, historically, down payment assistance were nightmare loans that nobody wanted to do. People would push them off. Whereas when Sierra Pacific started doing them, we really simplified the process of CalHFA and made it much easier for the broker and allowed them to start getting comfortable with doing down payment assistance and having it be something that they're able to offer their home borrowers. While CalHFA is a much smaller portion of our business, like Rob said, it is something we absolutely dominate in because I said that ease of use makes all the difference. And so able to close a loan in less than 30 days on a down payment assistance is just golden, specifically in this market. So with all that said, like Rob said, no one does CalHFA better. So let's go ahead and dive into it. So you can see here on this first slide, you've got CalHFA conventional, you've got Cal Plus conventional with zip, CalHFA FHA, and then at the bottom on the left-hand side, you've got Cal Plus FHA with zip. That can get a little confusing, like what's the difference between CalHFA conventional and Cal Plus? So I'm gonna really simplify it for you. There is basically two programs that you do with CalHFA. There is CalHFA conventional and CalHFA FHA. This is a 97% first when you're going conventional, and you pair it with a down payment assistance second from CalHFA. What you don't see on the screen here is that 3% is called My Home. It is a silent second. It does have to be repaid, and it pairs with a 97% first on a conventional. The minimum FICO for that, you can see, is 680 when you're going conventional. What you don't see here that we're going to talk about in a little bit is that there is two different types of income programs within the CalHFA conventional. So there is CalHFA conventional standard income, which is super generous, and then there's CalHFA conventional low income. So low income is going to follow that 80% AMI that you use for Home Possible, Home Ready. And when you're looking at the three options and you get a unicorn borrower in California that can qualify for a home with an 80% income, you really want to look at the conventional low income because mortgage insurance becomes a big part of the conversation on any loans, but specifically with CalHFA. So when you do a CalHFA conventional standard income, which most of your conventional borrowers with CalHFA are going to go, that is a 35% MI coverage. When you compare that to that unicorn 80% AMI, it's going to be an 18% coverage. So you can see why typically when you look at the rate sheet, the rate is going to be lower, as well as that huge reduction in the MI. Comparing it to the below, which is the CalHFA FHA, CalHFA FHA is going to be a 96.5% first with a silent second 3.5% from CalHFA. They are going to have a 640 minimum FICO, and you can see that you can allow different property types on both of the programs. One thing I do want to note is that if you ever do a CalHFA on a manufactured home, you do need to tether to a 680 minimum FICO for a manufactured home. There's going to be different layering compatibilities here. And so I want to tell you, when you look at that and you see Cal Plus conventional, it's like, where did that come from? When you have a first 97% and a second 3.5%, CalHFA, that's 100% financing, right? CalHFA offers an additional third optional lien. In that optional third lien, they offer in a 2 or 3% silent third lien that can go towards closing costs. Now, on that piece, when you're looking at what's the difference between the 3% or 3.5% with FHA, down payment assistance second, that is silent, but it does have a 1% simple interest that is accruing in the background, whereas the ZIP, that third lien that goes towards closing costs, is completely what you borrow is what you get. It's called ZIP, Z-I-P, for zero interest payment. So if you borrow $10,000, you're going to repay $10,000. So that is really the difference on these two CalHFA conventionals. But like I said, you want to know the difference between the MIs and how those three auctions really kind of compare to each other. All right, let's pop to the next slide. So you can see here, they have the program code, ZIP interest program, and the My Home Assistance. These are the down payments that I spoke about. They both are, the My Home is the second, and then you're going to also have the ZIP, which is that third optional. To be really frank with you, often the ZIP is not on the rate sheet, or when you look at the rate sheet, the ZIP isn't really worth the squeeze, really, because you'll have a rate that is at least 1 point higher just to get 2 or 3%. So if your borrower absolutely needs additional funds, it is an option for you if they can qualify with that higher rate. But in most of these situations, when the rate is so much higher on a ZIP, giving you an extra 2 or 3%, that means that most folks are not going to go with that option, really. Okay, at the bottom of your screen, you can see that 2-1 temporary buy downs are available. And buy downs with CalHFA have been super popular. 2-1 is a more recent addition that we've added to our suite. However, one option that people use quite frequently is a permanent buy down. So we know that 2-1s are temporary buy downs, but these are permanent buy downs, and CalHFA doesn't publish the actual pricing for these rates. You do need to reach out to your account manager or your account executive to be able to get these from the secondary market as to what CalHFA is offering that day for a buy down. Before we move on, I just want to let you know that when you're looking at buy downs, we know that buy downs can either be lender paid or they can be seller paid. But a CalHFA loan is a borrower paid transaction, and we are going to talk about how you structure that, where you get those funds from. ZIP is obviously one option of getting those funds for the closing costs. But another option that you need to know is that when you're doing a buy down, it's borrower paid, so it's only lender paid or seller paid for the buy down options. And because it's borrower paid, the lender paid is not an option. And the only way that you can do a buy down with CalHFA is through a seller paid concession. All right, let's pop to the next screen. All right, so maximum income limits. This is one of the best parts about CalHFA is it feels like everybody qualifies for a CalHFA because their income limits are so generous. So they start typically anywhere around 150 to 300,000 in the Bay Area. And when we talk about income limits in terms of CalHFA, but really all programs, what we're really discussing is qualifying income. The only program that there is an exception on this for is USDA, whether it's a USDA with CalHFA or a normal USDA. USDA uses household income, but all other programs, when you're using income limits, we're using qualifying income limits. So I just want to talk to you about qualifying income. Qualifying income is the income that your borrower is using to qualify for that loan. So that is their salary, that is their hourly, but it doesn't mean you have to include their overtime, their bonus, their commissions. You can, if it will not push you over your county's income limits. But if you have a really high base salary and the borrower also gets a bonus income, and that bonus income is going to disqualify them, throwing them over the income limits, you do not have to use that bonus, overtime, commission income to qualify for a CalHFA or really any program, like I said, aside from USDA. CalHFA is for primary residences only. There's no non-occupant co-borrowers or co-signers, and the first mortgage-based loan amount cannot exceed either FHA or conventional county loan limits. The max for My Home is going to be 3% for conventional and 3.5% as we discussed for FHA. All right, so this is an important part. This next part about all borrowers, including co-borrowers, must reside in the home and meet the definition of a first-time home buyer. CalHFA's definition of a first-time home buyer is not the same as the agency's definition of a first-time home buyer. So CalHFA, you can see a first-time home buyer is defined as a borrower who has not had an ownership interest in any principal residence, main word, or resided in the home owned by a spouse during the previous 3 years. This is super important. One of the most common questions I'll get is, hey, I had a borrower, she actually wasn't on the mortgage, but she lived in a home with her husband and they are now divorced 2 years ago. Does she qualify as a first-time home buyer? And the answer, unfortunately, is no, because we are a community property state. And so that borrower does not qualify as a first-time home buyer because she lived in a home owned by a spouse during the previous 3 years. Another question you'll get is, what if somebody was, they've been renting for the last 5 years, but a couple of years ago, they bought a second home in Tahoe with their brother. Well, a second home is not a primary residence, and they've been renting their own primary residence for the last 5 years, so they would qualify as a first-time home buyer. One thing to note, CalHFA is super particular about occupancy. So if your borrower has any mortgages on near their name, you are going to have to document 3 years of rental history, and they will want all 36 months of that. They will not take 34 months. It's super important to them. So I want to preface by making sure your borrower can document their rental their rental history rather, if they have any mortgages associated with their name. All right, let's go ahead and go to the next slide. Okay, so homebuyer education and counseling is required for only one of your home borrowers. One thing to note is that CalHFA currently only has their My Home, that 3.5% or 3% down payment assistance option. But in the past and in the future, they've had other different down payment assistance options. Some have been incredibly popular. And so sometimes they have additional homebuyer education that's required. However, right now, since My Home is the only thing they have, that is what they are going to really require. You can see here it's a face-to-face homebuyer education through Neighborhood Works or one of their HUD-approved counseling agencies. Okay, so one of the misconceptions of CalHFA or even down payment assistances is it forgiven? Do they have to pay it back? And yes, repayment of the principal interest of the My Home is due and payable at the time of refinance or selling the home. You can see the different options here on terms of when you have to repay that money back. And then the same goes for the ZIP loan. So that is a really important piece, is knowing that you're going to be really paying this piece back. Okay, so you know the basics of CalHFA. I just discussed those with you, and I really want to discuss structuring these loans and how you really do the structuring piece of it. In terms of guidelines, everything you really know about FHA or conventional is really going to be similar on a CalHFA loan, aside from some permanent resident EAD type of requirements. So make sure you reach out to your account executive if you have a borrower that's going to fall within those pieces. When it comes to structuring a CalHFA, we have to remember that these loans are borrower paid loans. And so you have to figure out who is paying for the loan officer's compensation, your compensation, as well as the closing costs. And so there's different benefits with CalHFA when you're looking at conventional, and there's different benefits when you're looking at FHA. With FHA, this in a market like we are in right now, you've got seller concessions. During the summer, we didn't have seller concessions, but in this market, we have seller concessions, and it is the perfect opportunity for a borrower to do a CalHFA with a seller concession. And I'm going to talk about why. So on a normal FHA, they're going to put 3.5% down. Let's say they're doing a lender paid deal. They're going to put 3.5% down, and then they're going to be also needing to come in with their 2% closing costs. That's 5.5%. On the CalHFA FHA, they're coming in with your, call it 2% of compensation and 2% of closing costs. This is 4%. So allowing a borrower to do a CalHFA FHA is a lower cash to close than doing a standard FHA. And that 1.5% doesn't sound like a huge difference, but when we're talking about thousands of dollars in a borrower's pocket as they walk into their first home, it makes a huge difference. And it's a big piece of why people do CalHFA FHA. Another big piece is that seller concession. Just as a recap, we know that FHA allows a 6% seller concession, whereas Fannie Mae only allows a 3% seller concession. So just picture with me that you have a unicorn deal. We're going CalHFA FHA. The seller is giving that max 6% seller concession. So the way you would structure this is a 96.5% first with a 3.5% second silent. And then you would utilize that 6% seller concession to pay you, call it 2%, 2% towards closing costs. And the remainder of the concession, we could permanently buy down the rate for that borrower. This is like the ultimate. Your borrower walks into the transaction with no money out of their own pocket, and all of that money in their pocket as they're able to be a first-time home buyer. When we compare this to the pricing betterments of going conventional CalHFA versus regular conventional, we're going to be talking about the pricing benefits. So when you do a conventional standard loan, you're going to have LLPAs, loan level price adjustments for a high LTV, maybe lower FICOs, or even a normal great FICO. Those LLPAs are out of control. So being able to do a conventional CalHFA, when you look at the rate sheet, it's just going to be the rate. So it's a bar paid rate. There's no price for the rate. There's no discount for the rate. The rate is the rate aside from if you're doing a high balance. And so this really allows borrowers to be able to take advantage of a pricing benefit with CalHFA conventional that they wouldn't get on the standard market. It reminds me of a story when I was actually in the field with one of my brokers, and the LO was like, "Oh, Brina, I've got these borrowers and actually going to take them 10% down CalHFA." And she's like, "I was going to do just a standard 10% conventional down payment, but I realized that they're buying a condo and their FICO is around 680. And instead of having all of those pricing hits, I can just take them CalHFA conventional. I'm going to rearrange their 10%. So I'm going to use the 3% from CalHFA's DPA. I'm going to use 7 of their 10% down to add their money with the down payment. And then I'm going to utilize that other 3% of their 10% down to go towards closing costs. And the rate is lower with CalHFA conventional because there's no pricing hits." And I was like, bingo. So there is pricing benefits that you can utilize with CalHFA when it comes to, really being able to get a lower rate for your borrower. All right, so let's go ahead into the next thing. And when I pull up this next slide, you guys are going to be like, here it is. And so before we talk about the Dream for All, what we've experienced in the past and what's really to come, one of the huge benefits of doing CalHFA at Sierra Pacific is the locking process. So locking a CalHFA loan with Sierra Pacific, we allow forward locks, which means all you have to be is in contract with an AUS approval in our system, meeting guidelines, and you can go ahead and lock that loan. A lot of lenders that have since started to do CalHFA typically want you to be disclosed or approved before locking a CalHFA, and that is not the case at Sierra Pacific. When we had the infamous Dream for All last spring, this was really the difference for, unfortunately, several borrowers that were either, if they had sent the loan to another lender, they were typically in line waiting for their file to be disclosed or approved so that they could reserve the funds needed to get that home, and the program shut down immediately. And unfortunately, so many people lost the ability to buy that home because they weren't able to lock up front. With CalHFA at Sierra Pacific, like I said, you were able to lock up front, reserve those funds, and then go ahead and disclose and get the file approved. This made a huge difference. Okay, so we can't talk about CalHFA without talking about the Dream for All. I don't know if any of you guys experienced that, but I've never experienced in 16 years anything like the Dream for All. If for some reason you're new to California origination, the Dream for All is a 20% down payment assistance. It is basically an ability to put 20% down. It's very similar to CalHFA's My Home, with the exception that it's not 3%, but it's 20%. And so this came in fast and furious. Nobody did more loans with CalHFA than Sierra Pacific. We are their largest partner, and we have such a long history with them that has been built over the years with trust. And so they are actually coming out with a new Dream for All. It is slated to come in March of 2024. And I want to just kind of review what the preliminary pieces of the way that they're re-engineering this for the new release is. They have stated that the next update will be coming in January of 24, but as of right now, they are allotting $255 million for the new program. They are looking at 120% AMI for the income limits. They are capping the max amount of money that you can bring into the transaction to 5%. And this is going to be a huge difference from what happened previously when the money just ran out so fast in 10 days because people were buying $1 million homes. They were putting their own 20% down with another 20% from CalHFA. They are also limiting the amount of dreams that you can do in a county. And so this will help. Some people are like, oh, Sacramento took it all or San Francisco took it all. And so these are the pieces that they're putting into place. Another option that they're offering is they want to do something with first-time generational liability. So they want first-generation home buyers. I'm not sure exactly how they're going to do that as of yet. And then lastly, they are looking at doing a max 150,000 or 20%, whichever is obviously lesser. Now, the thing that I feel like it just was so crazy at the beginning and throughout the process that they are trying to really change, and I think is they're doing a pre-registration approval process. And so they haven't released the details on how they're going to pull that off. But what they're doing is they're trying to make it to be less chaotic, really. And so those are the updates that are really coming for the Dream for All that is slated in, like I said, March of 2024. Some of the successes that we've had with California and other state bonds are really benefiting our broker partners because other states are paying attention and other states are really allowing to consider for the first time, maybe when we were historically only a retail only state bond, maybe we should open this up to other avenues like wholesale. And so this is actually the exact story of what's transpired with the Washington State Bond, which we're currently piloting. The Washington State Bond has only ever allowed it with retail. And as you know, so many folks have come from retail and people want that state bond in the broker space. And so Washington State Bond reached out to California and they said, hey, we're looking at piloting this with a wholesaler. If there was one wholesaler that you would recommend, who would it be? And CalHFA said, hands down, Sierra Pacific. And so that is the story of how we are starting to open up these programs with other state bonds, Washington being the one we're piloting now. And then Oregon Flex is going to be the next state that we're looking at opening up for our broker partners. And this trust, this reputation that Sierra Pacific has with these state agencies has really been the reason that we've been allowed to do other state bonds, such as Texas and Florida. And my colleague Paula is going to really walk us through those programs at the depth of her incredible knowledge. Paula is an experienced account executive with 35 plus years in the Florida market, and we are so privileged to have her on the Sierra team for the last 2 years. So with it, Paula, take us away.
Well, let me interject really quick, if you don't mind. I'm not going to let you off the hook quite yet, Brina. You got a couple questions to answer, and then Paula can get started. So one of the questions came through I couldn't answer. If you could speak to again, was permanent buy downs or temporary buy downs. If it's a seller paid buy down, is it permanent only, or can it be temporary also?
No, all buy downs are seller paid, and so you have the option of a 2-1 buy down or a permanent buy down. But because CalHFA is a borrower paid program, there is no lender paid option, and the only option is to have a seller concession pay for it.
Thank you. And then I have one more question for you. Would it be smart for a borrower to take a home buying training now if they're planning on purchasing in the spring?
Yeah, the home buying education is good for 12 months. And I do think that is actually a strategy for a lot of originators with their home buyers is right now in the winter to go ahead and take care of that. I mean, obviously it's $100 and 8 hours of your time. And so it's not a huge risk if for some reason you don't buy it. I would recommend it before they kind of start looking, just to have that under their belt.
Thank you very much, Brina. Totally appreciate your presentation.
Yeah,
we'll let Paula go, but one last question came through for me, and it really says, when Dream for All rolls out again, will it be a lottery type process? And the answer is that's what they're saying. We don't have details on that yet. What I will say is Sierra Pacific allows forward locks on these. And so that really is your commitment, is get your forward lock done. With that, and there's more questions coming through on Dream for All. We'll do our best to get those answered after this call. Paula now will speak to our other state bond programs, down payment assistance programs we have in Florida. A lot of your people are asking about Florida and Texas. So Paula, the floor is yours.
Welcome, everyone. We're so happy to be here. Thank you, Brina. That was quite an education for myself because I was not familiar at all. And it's really quite different from the Texas program and also for the new Florida programs that we have piloted on the broker side, for one of the few in Florida. So we're going to start out with Texas, which should be the next slide.
Next slide, yeah.
everything I have to say that she said about the CalHFA, I was so amazed because it's really quite different for both Texas and Florida. So I was like, wow, that's really different. Texas is somewhat similar to Florida, and I'm going to go over a quick overview and touch on some tidbits of the program. They have a lot of likeness, and then again, they have a lot of things that are different. The TSHAC program, or the Texas Affordable Housing Program, offers down payment assistance in the form of grants, and they also offer a forgivable second mortgage, which is really a rarity in Florida anymore. And they offer their programs in 2 types of down payment assistance. And we'll go over the quick overviews, but they offer basically a grant, which they run out of as fast as the California Dream went. The grant is gone in no time at all, because that program typically is a true grant and doesn't have any second lien for 6 months. Once they live in it 6 months, there's no second lien whatsoever on the grant program. So that's pretty unique. But what they do have is 2 types of programs, and then you'll see, you'll get into the rate sheets, and it gives you a big breakdown. The Hometown Heroes for Texas is for the teachers, the firefighters, the EMS, your police officers, your correctional officers, and your veterans. That is very specific to those occupations. Then you have your regular Texas Home Suite Texas, and that is for your regular low to moderate income buyers. Interesting enough, those 2 programs do not require you to be first-time home buyers, which is very rare. However, they have mortgage credit certificates. And once we add that to any of the loans, which they do offer, and it's a really nice benefit, it's a special tax credit that reduces the home buyer's federal tax liability. And in return, that will lower their monthly PITI and help them to qualify with their DTI ratios. At this time, it has to be combined with one of the down payment assistance programs. So as soon as you add the mortgage credit certificate to this, you immediately do have to become a first-time home buyer. Income limits vary by county, which is very similar to Florida. And they have expanded income limits for different targeted areas. There's also purchase price limits for basic and for non-targeted areas. Again, very much similar to what Florida has. And again, the MCC, or the mortgage credit certificates, are exclusive for first-time home buyers only. They were offering it as a standalone, but as of November 1st, it has to be combined with one of their 2 programs. The loans for down payment assistance have minimum scores, credit scores of 640, and with an AUS approval, maximum DTI of 50. The non-bond or no MCC, no first-time home buyer requirement, again, that is, you have to look at their rate sheets because they don't have a minimum or maximum loan. Any given day, their rates change every day. And because of the flexibility of our underwriting, we've had to move from different programs depending on what was available on a given day. So you have a team that's very familiar with working with down payment assistance programs. So the loan comes in and they've applied for a down payment assistance on the 3-year deferred. The grant has not been in play for a while, so it's almost been non-existent and still is. So if you open the TSHAC rate sheets, and you go in to look at what's available, you will see that the 2%, the 3%, the 4%, or the 5% of the loan amount, which is what they give for your second mortgage and your soft second, any given day, you might only see the 3 or 4%. I've not seen many 5% at all in Texas. And most recently, on a couple of the programs, just 2% has been available. So that program, every day I've seen rate changes. It's fluctuated much more than what has happened in Florida. There's also income limits on the regular hometown home suite Texas for Home Loans program for both of them. So again, the same as the MCC, you have income limits that vary by county, and then you have higher income limits by the targeted areas. This is probably a good overview of what it gets into. All the loan offices for the TSHAC must take their classes online with TSHAC. So we encourage you to go in there. You can get your rates. In order to be certified to offer the Texas, the TSHAC loan, you must take that certification and submit that to Sierra Pacific. They also, like Florida, and I'm surprised this did not come up for California, but I didn't know that program very well. You have to be a resident of Texas for the loan officer to offer it in Texas. The same as Florida qualifications. You have to be a resident of Florida and a loan officer licensed in Florida to be able to offer the Florida program. So in those two ways, there's similarity as well. Next slide. Okay. The TSHAC loan, that is, I'm just doing a quick overview on that one, and then we're going to go right into the most popular program in Florida. Down payment assistance has been a big part of the business here in Florida for a long time, and we've always done it with our group. Hometown Heroes has made it hugely popular. The last year, they're in their second year that they've come out with Hometown Heroes. And the first year, they mirrored a lot of the Texas programs where you had to have a page and a half of occupations that would qualify. They received so many calls on it at the state that they actually did away with all the occupations. So you can do a Hometown Heroes and opened it up in June of this year for everybody. So you no longer have to be a teacher, a firefighter. They were inundated with calls. She's a nursery school teacher. Can we get her in? She works as a CNA for a private patient. Will that qualify? So as of June 1st this year, when Sierra Pacific decided to take the bond alternative program on, we also went through all the changes, and it's been much easier. All of the Florida programs require that you must be a first-time home buyer. Hometown Heroes requires this as well. The borrower also has to be employed in a full-time position and work at least 35 hours per week. Only one borrower has to satisfy this requirement. So if one borrower is retired, you're still fine. Veterans are exempt from the first-time home buyer requirement as well. It has to be a primary residence. And again, there's maximum income and county limits by counties. There's no purchase price limits for Hometown Heroes. So they go right by your Fannie Mae, your FHA limits, or your USDA. So you don't have to adhere to any kind of checking purchase price limits, checking targeted areas. That's a big plus. And then for credit qualifying, or actually it should be for your first time homebuyer qualification, all they require is the certification for Hometown Heroes. You don't have to supply 3 years tax returns to show that you've never owned a home before. You sign the certification on your 1003, you do your Hometown Heroes certification, and you're done. As far as the second mortgage and the assistance you use, the second mortgage is a deferred second mortgage. It's never forgiven. So as long as you have it, if you refinance it or you sell your home, it will have to be paid back. The maximum amount of the assistance on the Hometown Heroes is 5% of the loan amount, up to $35,000. As of June 1st, they put a minimum on it of $10,000. So now, if you are buying a smaller condo and you may have only been getting $7,000, you can now get automatically a minimum of $10,000, so that everybody's going to get that minimum of $10,000. Regardless of your AUS approval, and that goes for conventional, FHA, or USDA, Our maximum DTI on the program is 50. This program can take in a single family home, multi-units, and for manufactured housing, which is also available, the DTI is lowered at 45. The minimum FICO for this program is 640, and for manufactured homes, 660. We make these very easy because you can submit one loan to us. We help you work through the first and second. There's no minimum or maximum. They can combine their money with this program. We see a lot of people come in some of our areas that have down payment assistance. They're so restricted when they go to the cities, and they're at that 80%, like the Home Ready and Home Possible. Our house prices are so high here that they often don't meet the income guidelines, whereas the Hometown Heroes has the very highest income limits. That goes in by county, and we do a lot of condos with this, where they can combine it, and they're coming in with a 50% first and a 95% second. So they can use as much of their own money and combine it with whether it be a minimum of 10,000, they can avoid the MI at all costs altogether, and they could have a CLTV of 85 or 90%. So they have no caps on that. I have one in right now at 50 and 90, so they can have a limited review condo, which saves them on their condo approvals. As Brina said, we have a fabulous condo department, so those go very quickly, but it's even quicker when you have a limited review in the state of Florida, because we have more restrictions than any other area because we have so many condos. So our CLTV for our limited review condo is capped at 90, but they can use their money and part of their bond money, whether they take the 10,000 here or they go into the bond, and have a very low LTV and have no MI and have a limited review condo as well. So this would be, as far as Florida coming in, one of the first times that they've ever worked with the broker community. So they've been making changes and improving as they go along. And it's actually, the brokers are very excited to have it. I always say the Hometown Heroes is the first start, but when they run out of money, and they call that the bond alternative or the TBA. There's a whole list of products in the website that you can go and see. These prices can change daily, but for the most part, they're pretty stable. And these are all done as lender pay transactions, which is quite different than CalHFA. The bond loan we'll go into next. When the Hometown Heroes money runs out, and it did run out in 30 to 45 days, we still have the bond loans running consecutively because they self-fund themselves. That never runs out of money or has a cap on it. So if you started out Hometown Heroes and you were only getting 10,000 anyway, the nice part is Sierra Pacific is one of the only lenders offering the bond alternative. No, the bond alternative is we might have one competitor that's trying to get in there, but once you run out of money with Hometown Heroes, when we fall to our bond program, we're the only lender in Florida that is offering it. Next screen. Now, the bond program at first seemed very strange to everyone because everybody heard, and all the realtors and everybody has heard about Hometown Heroes. Everybody wants the Hometown Heroes, whether or not they can even qualify for it. Nobody wanted to hear about bond at all because they don't understand it. So what they don't understand is easier to avoid altogether. But it's a nice talking point for your realtors. And your realtors love it to have a lender on the line to talk about it. And if you run out of money with Hometown Heroes and you still, or you're short funds with a current loan, you can come back and get your bond money in here. It's not hard. It's not like the state DPA programs where they have to go in and they'd find out last minute they don't qualify or they're making too much money. The DTIs are typically only 43 on those. So now they're short money and they've taken their home buyer education already, which is good for 12 months, same as California. But the nice part is you can, I tell all of my brokers, you still have an option to bring your loan here. Even if you've had it somewhere else, transferred appraisal comes in conventional, and you close these loans in 7 days to 10 days. They're quick, especially if we're just fixing someone else's mess up. A lot of times you call me and say, I don't know what to do with that loan, or I had a problem with it. Usually I pull it out of you, what was the problem, and then figure out, well, that's not really a problem. Why did you present it that way? It could have been done this way. That helps save a lot of deals. And now you look like a hero because your loan closes in 7 to 10 days because you had it all packaged, but it wasn't put together exactly the right way it needed to be. These programs come with conventional, FHA, USDA. Sierra does not offer the VA bond at this time, and I don't think anybody's really ever used it. With the bond program, the biggest difference between Hometown Heroes and the bond program is, number one, you don't have the 35-hour work week that you have to work as a full-time employee. So you might have 2 retired borrowers, and they're not going to qualify for Hometown Heroes, but you can still get them a little money to help out. So a lot of times they're coming into Florida, they're moving in, they have some money of their own, and they're going to add to it. That $10,000 bond might keep them right below the limit of having to need MI. So the combination, any way you want it, will work with the bond. Now, the big difference with the bond and the Hometown Heroes is there is a reduced income. And much like Texas, and I think California, but I'm not sure if I heard that right, they have a target and a non-targeted area. And so once you get into bond, there's a little bit difference in the income. It's a little bit less. Most of the retired borrowers may have less income anyway, and some of the income may not be counted. It is a primary residence only. The income limits do apply, and they are lower than Hometown Heroes. There are purchase price limits. So we have to look at 2 things when we do bond. And then the household income calculation is not just on the borrower themselves. Much like anyone that does USDA, they look at all of the household income of everyone that's 18 or older in the property. How do we know this? We might see it on their bank statements. It could come up in underwriting. Most times that's not been an issue, but the spouse cannot buy without the other. So he has to be a first-time home buyer too. So unlike the California property, the spouse's income is going to come into play for the Florida housing program. The down payment assistance for the bond is not a percentage now like Hometown Heroes. It's a flat $10,000, and they're all they give you 2 options on that $10,000 bond. You have a 30-year 0 interest deferred with no payment, which is the Florida Assist. That's what everybody takes. And I say, okay, well, if they're really concerned about wanting to pay it down a little bit, they can still take the 15-year fixed option. It's a 3%, and it's a $69 payment a month. So if you have someone thinking, well, I'm going to be in here in a long time, I may not be refinancing. What if I sell it? I want to get it paid down. None of these loans have prepayment penalties. So if you come into money and you want to get rid of your Florida Hometown Heroes loan or your bond loan, you can pay them off ahead of time. There's nothing that says you can't. But if the house is sold or refinanced, these are non-forgivable. So you will have to pay them back. So you can pay them ahead or off at any time. Maximum DTI for this program and overall underwriting seems to be the same with the actual underwriting guidelines for the DPAs. It's a 50% for your FHA, your Fannie Mae HFA preferred. And then if you're doing manufactured housing, your DTI is capped at 45. Your minimum FICO on the bond program is 640, and your manufactured housing is 660. And the big difference that everyone doesn't like about the bond program is they have to supply 3 years tax returns and or transcripts to show that they've never owned a property before. So that is your big difference between the 2. One requires employment, one requires the 3 years tax transcripts, and a lot of brokers say, I don't want to have any surprises, so I don't really care for the bond. If they're retired, there really are no surprises. They haven't owned anyway. But again, it's a lot of information. Next slide. Oh, we're missing a slide.
Well, it's good time to pause. I do have some questions for you, Paula.
Okay.
We got a question about something we knew that was going to come up was compensation. And so let me quickly just touch on that. When we first got access to CalHFA for the broker community, they also limited compensation. And now CalHFA is much different. And so we do think that Paula will tell you what the compensation max is for both. But we think that, in fact, they recently increased it, right, Paula? And so
Yes.
can you explain what the max compensation is for those loans, TSHAC and Florida?
Yes. T-Shack is borrower paid only, and that's one origination. And if you have a lower score, I believe they give you a little bit extra on that. That's with the rate's a little bit better. On the Florida housing, we started out with the bond being one origination only. Then they decided this is new to them, the broker, having the brokers involved in this. So then they changed everything. Hey, we don't want to, we've got brokers involved and we're seeing a lot more business out of it. We want to expand it, but we want to give the borrowers the most money for it, especially when 10,000 on the $10,000 bond, 1% is going off to the broker. So they switched everything to lender paid. So now going forward, all the programs went to lender paid. Initially, Hometown Heroes was not allowed to be lender paid. Now everything is lender paid and with a compensation of 1 1/4.
Paula,
Okay.
I have a question. We've gotten a lot of questions that have come in. If you can kind of address both Texas and Florida, if you don't mind, because you did cover quite a bit
Oh,
in the
yes.
3 products. So can you just clarify for Texas and for Florida, do the LOs need to reside in the state to do the loan in addition to being licensed? And also for each product, if there is that certification required of the LO to take in order to offer that product?
In Texas, they have to take a certification through the Texas Housing Online in order to offer it. And I'm sure they have the same thing we have. You have to be licensed. If you're licensed in Texas and you reside in Texas as a loan officer, you can't offer Florida and Florida bond. If you are a licensed LO in Florida, and our requirement is we require for both. You have to fill, we don't have to fill out the form for Texas because Texas requires the broker to be certified. So they have their certification already. But in Florida, there's no certification. They rely on the lenders for us to train the brokers. So there is no certification, but Sierra Pacific does require for that certification only brick and mortar broker has to be in Florida for at least 1 year, the broker's office, and the loan officer has to reside in Florida at least 1 year to be able to offer the Florida programs as well. So we require a driver's license for each LO on the company list. Now we've had some exceptions, and Florida has been, I've had personally 2 offices where one broke up a partnership. He's been a broker of mine for 20 years. And I sent a copy of their NMLS and I said, hey, this is a guy who's been in a partnership for 20 years and they broke up. His new company's only 2 months old, but here's a 20-year veteran of Florida. We're not going to let him do it. Exception approved. And I had a second one, the same thing. Another 20-year customer opened up his office, sent the NMLS. He actually went crazy before I did, but we sent up the letters to the Florida housing office, if approved. So what they want to do is make this for the Florida community and the Florida brokers. They're the ones that know the program the best.
And is that the same requirement for California, CalHFA? Like, does the loan officer has to be a resident and licensed both in California? Brina, do you know that?
No, that's not the same requirement. They do obviously have to be licensed in California. And then in terms of their compensation, they can make up to 2 1/4 or their max lender paid compensation with us. So if, for instance, if the compensation agreement with Sierra Pacific is 2%, they would only make 2%, not 2 1/4. But if they have a higher compensation, and they can lower it, they can obviously they can have a lender paid compensation agreement with us for 2 1/4 and only do it at 1%. So really flexible. And to really Rob's point, I think that it's really important to point out that one of the reasons that we're so far advanced than other lenders with CalHFA is we've been doing it so much longer. And so Florida and Texas, I do also agree, will follow suit as they get more comfortable with us and us more with them. It's just in the beginning stages, and that trust will continue to build and more things will be opened up.
All right. And Rob, there was a teaser for some other states you guys are launching. Do you want to cover that? We are almost at the top of the hour. There are a few other states, if I'm right, you are looking at introducing such programs. Is that?
Yes, Brita actually did tease that a little bit in her presentation. We're piloting the Washington bond right now, and we're currently negotiating with Oregon Flex. And so if you have questions about those two state bonds, we're not stopping there. We're trying to go across the nation and really get more for the broker community in regards to state bond.
All right. So this was a fairly intense session. We learned so much, in the season of giving. What better gift than the gift of knowledge? So you guys were amazing. So thank you so much again to Sierra Pacific for coming and sharing a wealth of knowledge with the broker community. We got some really good questions, and I think all of you guys answered them really well. So Rob, what kind of marketing resources does Sierra Pacific provide to brokers? Because these programs are very valuable. I think a lot of brokers don't know about them. So how can Sierra Pacific help ARIVE mortgage brokers with marketing resources? Can you share anything on that?
Absolutely. We have marketing on all three products. We also have co-branded marketing for our brokers. So please, wow, this was a great presentation. A lot of great products that can help a lot of people. Great job, Brina and Paula, on your presentations. Also, we want to thank ARIVE team again for this partner spotlight. We're thrilled to show the ARIVE community how Sierra Pacific can help grow their business. If you're not signed up, please scan the QR code, give us your information so we can have an account executive contact you today. And if you are looking for help, help with the marketing on any of those products, same thing, reach out to any of us. The email addresses are down below. Scan the QR code and ask for help.
All right. And this session has been recorded. I think a few of you asked that. So this recording will be available on ARIVE's YouTube channel. So if you go to youtube.com, search ARIVE. So this will have a permanent memory over there. But again, I want to thank everyone for joining today. We appreciate everyone's time. Wish everyone happy holidays. Thank you so much.
Thank you.
Thank you.